Welcome to the third and final video for Chapter 6. This video is going to cover a relatively new provision that was passed with the Tax Cuts and Jobs Act, known as the Qualified Business Income Deduction. The Qualified Business Income Deduction comes under Section 199A. What was the reason that Congress passed Section 199A, the Qualified Business Income Deduction? Well, back in 2017, one of the major provisions of the Tax Cuts and Jobs Act, that TCJA, was to reduce the corporate income tax rate from 35% to 21%. Why did Congress want to reduce the corporate income tax rates from 35% to 21%? Well, at the time that this was passed, you can see that the 35% statutory corporate income tax rate here in the United States was well above the typical distribution of tax rates across the rest of the globe. So the goal of Congress was to make the United States more competitive by reducing the tax rate to something that was more aligned with corporate tax rates imposed by the rest of the world. Okay, so now we understand the corporate side. You should also know the Tax Cuts and Jobs Act reduced individual tax rates. The average tax rate reduction, however, was 1.7% for all taxpayers. So corporations got a 14% reduction in their tax rate, but individuals got a 1.7% reduction for all taxpayers. In the top tax bracket, where small businesses may be reporting, that tax rate reduction decreased from 39.6% to 37%. So this means large corporations got a 14% tax rate reduction, but small businesses only got a 2.6% tax rate reduction. And so, as you might imagine, this disparity caused some concern. First, think about it. Amazon, they had $11 billion worth of profit in 2018. Now their marginal tax rate is going to be 21%. On the other hand, if you have an independent pharmacy that generates average profit of an independent pharmacy, they're going to pay 37%. And then there's entities in the middle who have moderate amount of taxable income of $10 million. If they change their structure to be a C corporation, they could pay only 21%. But if they remain as a flow-through entity, either a partnership or a sole proprietorship or an S corporation, they're going to pay a marginal tax rate of 37%. And so there was a lot of discourse about whether this was a fair tax structure. Well, in recognition of that, Congress passed the QBI, or Qualified Business Income Deduction, to help reduce the tax rate that would be applied to small and medium-sized companies. Okay, so now that we have a little bit of background with respect to the history of the Qualified Business Income Deduction, let's get more into the details. First, what is a qualified trader business? A qualified trader business is any non-corporate taxpayer. This could include sole proprietorships, S corporations. So even though that sounds like a corporate taxpayer, what they're referring to above is the C corporation. An S corporation is a flow-through entity, or partnership. The definition of this is going to follow Section 162A, which is a facts and circumstances test about what type of tax entity a business is. They require that the taxpayer is actively engaged in a trader business and that business has a profit motive. We're going to look to the continuity and regularity of the activity to determine whether this is something that they're engaged in with respect to the profit motive. So, for example, if you have a yard sale and you do it once a year, then that's not really going to be something that you can count as engaged in trader business. However, if you go around to yard sales and pick up various items and then resell them on eBay on a regular basis, then that could qualify as a qualified trader business because you're actively engaged, you have a profit motive, and you're doing this on a regular basis to make income. Well, because the qualified trader business has to be active, there's a question about rental property. Rental property, as we've learned, by definition, is a passive activity, and therefore it would not normally be considered a trader business. However, there is an exception with respect to this rule that allows rental activity to count as an engaged in trader business activity. It depends on the type of property, the number of properties that are rented, the nature of the owner's involvement, and the rental period. To get more specific, rental real estate activity will be treated as a trader business if separate books and records are maintained for each rental activity. The owner provides at least 250 hours of rental services per year for the activity, In order to justify this, the taxpayer is going to have to maintain contemporaneous records supporting the rental services performed. So what counts as a rental service? Well, rental service includes time spent on maintenance, repairs, collection of rent, paying bills, providing services to tenants, supervising contractors and employees, and any efforts made to rent the property. The last category can include advertising as well as negotiating and executing a lease. We also need to understand something else. Rental real estate activity does not apply to any residence that the taxpayer uses for more than 14 days during the year, which means that taxpayers who have a vacation home and they use that personally but also rent it out may not qualify if they stay there more than 14 days during the year. Okay, so these are a lot of special rules with respect to rental activity, but I bring them up because rental activities are very popular among individual taxpayers. Now let's get into what exactly is qualified business income. Qualified business income is ordinary income earned from a qualified trade or business, less ordinary deductions incurred in that trade or business. So it's the net taxable income yielded from a qualified trade or business. You're going to take your revenue, less your ordinary and necessary business expenses, which we learned you can deduct all of those as a 4 AGI deduction, and everything less is going to be your qualified business income. And recall, we report this net profit on Schedule C. Losses from a qualified trade or business do not generate a qualified business income deduction. So if you have a net loss on your business, you're not going to be eligible for a qualified business income deduction this year. And since you're going to carry your loss forward to apply it against the next year's income, remember that excess business loss rule that we saw? That's going to reduce your eligible qualified business income deduction for the next year and maybe a couple years afterwards as well. If you do have multiple qualified trades or businesses in the same year, you will be eligible to offset the losses on a pro rata basis with positive income from other qualified trades or business. A little bit more on what qualified business income is. It does not include any income that is not trade or business income. So this would not include wages that you earn as an employee. This is active income, but it's not trade or business income. While this is a general rule for taxpayers, you should know that there are a couple exceptions. First, it would include reasonable compensation paid by an S corporation to an owner who also works as an employee, and it can include guaranteed payments that are made from a partnership to a partner. In addition to wages of employees generally not counting for the qualified business income, capital gains and losses, dividend income, and interest income are all not considered qualified business income. This is because these are passive income activities. Okay, so now that we know what a qualified trade or business is and we know what qualified business income is, the next definition that you need to understand for the qualified business income deduction is the designation of a specified service, trade, or business. In general, specified service, trade, or businesses are any businesses where an employee's knowledge is the primary revenue generator of the business. So this would include businesses for health professionals such as doctors, lawyers, accounting, accountants, including tax accountants, actuarial science, performing arts, consulting, athletics, financial services, and brokerage services. Anything that doesn't fall under this category is considered to be a non-specified service, trade, or business, and we abbreviate each of these by SSTB and non-SSTB. The reason why it's important to know the designation of the type of business is because the qualified business income deduction is limited, and that limit applies differentially based on whether the business is considered to be one of those SSTBs, again, a business where the primary revenue generator is the knowledge of the employee, or a non-SSTB business. This gets really complicated really fast, and we're going to go through a number of examples to help you understand this. But before we get there, let me help you understand what you need to know for the second midterm exam. When it comes to the qualified business income deduction rules, you're going to need to understand how to apply that rule when taxable income is below $170,050 or $340,100 as a married filing joint couple. That's because we can reduce the decision making to this portion of the table. Basically, what you're going to do, and it doesn't matter whether it's a non-SSTB or it's an SSTB, you're going to pick the lesser of 20% of QBI or 20% of the modified taxable income. So what is modified taxable income? It's going to be your taxable income before the QBI deduction, and you have to reduce this income by your net capital gains. So let's look at an example. Amani, he has Schedule C profit of $110,000. He makes a contribution to an individual retirement account of $6,000. He also has other 4 AGI deductions that amount to $2,500, and he has itemized deductions of $23,500. So his modified taxable income for the purpose of the QBI deduction is going to be $78,000. Amani's a single taxpayer, and as we learned about, he's going to have QBI of $110,000. How did we get here? He has revenue of $459,000, and he has ordinary and necessary expenses of $349,000. His modified taxable income is well below the threshold of $170,000 for the single taxpayer. So when he is determining his QBI deduction, he's going to pick the lesser of his QBI times 20% or his modified taxable income by 20%. His QBI is $110,000, and we multiply that by 20%, and we find out that he has $22,000 for number one. His modified taxable income is $78,000. We multiply that by 20%, and we find out that he has $15,600. Since we have to pick the lesser of these two, in his case, he's going to pick the modified taxable income of $78,000 times 20%, and his QBI deduction will be $15,600. Since Amani's modified taxable income is well below the first threshold, it doesn't matter whether Amani engages in an SSTB or a non-SSTB. His QBI deduction computation is identical. In addition to understanding that QBI deduction, you will also be responsible in your second exam for understanding the qualified business income deduction when the taxable income before QBI deduction exceeds the upper threshold of the phase-out, which in this case is $220,050 for single taxpayers and $440,000-ish for married filing joint taxpayers. Note, these amounts are indexed for inflation, and so they are eligible to go up each year. When it comes to this particular scenario, you should understand that taxpayers who run SSTBs are not going to be eligible for a QBI deduction. However, if the business is a non-SSTB business, then the taxpayer will still get a QBI deduction, but the eligible QBI deduction will be limited to the amounts calculated under B of this table. So let's use some examples to see how this works. First, let's assume that Amani is operating a non-SSTB business. He's a florist. Here, he makes QBI of $280,000, and his modified taxable income is going to be $258,000. So he's above the upper limit of the QBI deduction thresholds. We also need to know what his W-2 wages are to employees. Let's say that he pays employees $45,000. And that he also owns a delivery truck that's exclusive business use so that he can deliver flowers. And the purchase price of the delivery truck was $130,000, and its adjusted basis is $85,000. In computing what his QBI deduction is, we're still going to start with Part A, where we pick the lesser of the QBI times 20% or the modified taxable income. When we multiply his QBI of $280,000 by 20%, we find out that he would be eligible for up to $56,000 in QBI deduction. Since his modified taxable income is $258,000, when we multiply that by 20%, we find out that he's actually going to be eligible for only $51,600 of QBI deduction. Now that we know his maximum QBI deduction under A, we can apply the limits that come under B. B is limited to the greater of 50% of the W-2 wages or 25% of the W-2 wages plus 2.5% of any capital investment made in the business. The first one's easy. Take the 50%, multiply it by $45,000, and you find out that he has $22,500 under the first test. Under the second test, we're going to use the same $45,000 wage, but now we're going to multiply it by 25%, and that's going to be $11,250. Then we multiply the capital investment in the business, $130,000, his cost of the delivery truck, by 2.5%, and that comes up to $3,250. When we add those two amounts together, we find out that the second threshold is $14,500. B's test says to pick the greater of these two, so we're going to pick the 50% of wages for Amani. Since this scenario covers a non-SSTB, but Amani's modified taxable income exceeds the upper threshold, his QBI deduction will be limited to the $22,500. Coming back, we can see that this calculation is really easy for SSTBs. If Amani instead was a tax accountant and he exceeded the upper threshold, his QBI deduction is completely disallowed. That's complicated enough on its own. However, the qualified business income deduction is incredibly valuable for a significant portion of taxpayers. So you should understand at a minimum how the QBI deduction works when the modified adjusted gross income is below the lower threshold limit, and how it would be applied based on whether it's an SSTB or non-SSTB when the modified adjusted gross income exceeds the upper limits. I'm going to cover the final scenario under the qualified business income deduction, and that's the between scenario. But before I get into this, I want you to understand that this will not be on any of your exams in Accounting 405 this spring semester. I cover this for two reasons. One, this could also apply to taxpayers that you know, so you should be aware of how it works. And second, while I don't place it on my exams, it is an item that is eligible for testing on the CPA exam. So as you get through to that process, you may want to know how this works, and seeing it here can help you as you relearn it for the CPA exam. So let's cover the scenario where we have taxable income before QBI deduction between the two threshold amounts. We're going to have to phase out the QBI deduction, but not fully like we did in the previous scenario. The goal of this is at the intermediate level of income. Congress didn't want the W-2 capital investment limit to be overly harsh. So they phase in the W-2 wages and capital investment limit. And we see this portion here in the yellow. And as you can see, this has the most words. It's got a lot going on. But I think working through some examples can make this pretty clear. Let's start again with the case where Amani is a florist. He's operating a non-SSTB. He has qualified business income of $180,000 and modified taxable income of $200,000. He again is going to have the same W-2 wages, and he has the same delivery truck. In all cases, we're going to start with that first limit. We're going to pick the lesser of the QBI deduction or the modified taxable income. Before I get there, I can tell you that QBI is less than the modified taxable income, so we're going to be picking the first one. We take 180 times 20%, and he has an eligible QBI deduction of $36,000. Just for completeness, I'm going to show the second test, but like I've already said, I could have looked at the beginning scenario and told you that we were going to be picking the 20% of QBI as the maximum eligible QBI deduction. The second part is I have to identify what's known as the excess amount, and this is going to be A minus the test that occurs under B. Test B is to limit the QBI deduction to the greater of 50% of W-2 wages or 25% of W-2 wages and 2.5% of the capital investment. We take 50% of our $45,000 and we find out that we have $22,500. And if we were to complete the other test, that would only yield $14,500, and we get to pick the greater of these two, so we're going to pick $22,500 under B. Now that we have both A and B, we can compute our excess amount as the general QBI deduction less the limitation under B to identify the excess amount. And when we put in our numbers, we find out that the excess amount is $13,500. Note, in the case where we had QBI that exceeded the upper threshold, our QBI deduction was fully limited to $22,500. That is the maximum limitation that applies under the rules for a QBI deduction for non-SSTBs, which means that $13,500 of the possible QBI deduction was completely eliminated. Under the middle scenario, this is the maximum QBI deduction that could be lost as the modified taxable income goes up to the upper threshold. Since we're trying to phase it in, make it not so harsh, whatever we calculate as the reduction in QBI has to be less than this, which means that our qualified business income deduction is going to be greater than $22,500, but less than $36,000. So let's cover the math on how we get there. The third step in this process is to identify what's known as a phase-in percentage. We find the phase-in percentage by taking the modified taxable income less the lower threshold amount and we divide it by the phase-in range. So this looks a lot like what we learned for the student loan interest deduction. Here, our modified taxable income is $200,000. The threshold amount comes off the table, and right now for 2022, that's $170.50. And the phase-in range is the difference between the lower threshold and the upper threshold. For single taxpayers, that's $50,000. For married taxpayers, that's double, $100,000. So we're going to divide that difference by our $50,000, and we find out that our phase-in percentage is 59.9%. We multiply the excess amount by 59.9%, and that tells us that we're going to have a reduction amount of $8,086.50. Our allowable QBI deduction then is the difference between our upper QBI deduction that we found under A, $36,000, and the reduction amount of $8,086.50. So under this scenario, Amani's qualified business income deduction will be $27,913.50. All right, that's a lot, but it gets a little bit more complicated when it comes to the SSTB businesses for the phase-in range. Remember here, if you're operating an SSTB, your qualified business income deduction is identical to what you would have gotten had you been operating a non-SSTB if you're under the lower threshold limits, but it's going to be completely phased out if you exceed the upper threshold limits. This means that the phase-in is going to be more harsh for the SSTBs. So how do we get here? Even though it's more complicated, we're still going to start the same way. We're going to multiply 20% by the QBI and modified taxable income. And we're going to pick the smaller of those two. And since our QBI income in this scenario is less than our modified taxable income, we have a maximum QBI deduction of $36,000. Next, we're going to identify the excess amount, just like we did under the non-SSTB scenario. So this means that we have to identify the limit that would be placed under B, which is the greater of 50% of the W-2 wages or 25% of the W-2 wages plus 2.5% of the capital investment. We're going to go ahead and calculate both of those amounts, and we find that the 50% of W-2 wage limit is the greater of those two. So now that we know A and B, we can calculate the excess amount. Since the numbers are the same, for the non-SSTB and the SSTB businesses, the excess amount is still going to be $13,500. Now we have to apply some limitations to this. In step 3, we're going to identify the phase-in percentage. We calculate this the same way for an SSTB that we did for a non-SSTB. We're going to take our modified taxable income, subtract out the threshold amount of $170.50, and we're going to divide it by the phase-in range of $50,000. Our phase-in percentage, again, is going to be 59.9%. For SSTBs, we also need to identify an applicable percentage. The applicable percentage is 1 minus the phase-in percentage, which is 100 minus 59.9 or 40.1. Here, we're going to multiply A by the applicable percentage. So we're going to take 36,000, multiply it by 40.1%, and our maximum QBI deduction is going to be limited to $14,436. Then we're going to take our excess amount and we're going to reduce it by both the applicable percentage and the phase-in percentage, which yields a reduction of $3,242.69. This means that if Amani is operating a SSTB, his allowable QBI deduction is only going to be $11,193.31. So even though he had the same QBI, the same modified taxable income, the same W-2 wages, and the same capital investment, if we compare the phase-in, we can see that the QBI deduction is going to be much more restricted under the case where he's operating an SSTB relative to the case where he's operating a non-SSTB. So again, I want to let you know, I understand that this portion of it where we have that middle range and we're phasing in the QBI deduction limitation is very complicated. And I'm not going to test you on this on your second midterm exam for Accounting 405 in the spring 2023 semester. But hopefully you will be able to use this if you need to help somebody who is eligible for a QBI deduction, is somewhere in this phase out range, and or as you prepare for the CPA exam. I'm sure that the three videos combined give you a really good sense of all of the material that's covered in Chapter 6 with respect to deductions. Because deductions provide tax benefits to taxpayers, this is a topic of interest to many individuals. You should help those individuals to make tax optimized decision making wherever possible.